Hello everyone, welcome to the market opening bell for Friday, March 14. Hong Kong stocks fell for the fifth consecutive day. The Hang Seng Index opened 16 points higher on Thursday but fluctuated thereafter. It briefly rose 112 points to a high of 23,712 in the morning before retreating. In the afternoon, it dropped as much as 401 points to a low of 23,198. Though losses narrowed by the close. The index ended the day down 137 points or 0.6% at 23,462, marking a cumulative decline of 907 points or 3.7% over 5 trading days. The H-share index fell 41 points or 0.5% to 8,640, while the Hang Seng Tech Index dropped 97 points or 1.7% to 5,747. Total market turnover decreased to 233.8 billion Hong Kong dollars. Mainland Chinese markets opened lower and continued to decline. The Shanghai Composite Index fell 13 points or 0.4% to 3,358, while the Shenzhen Component Index closed at 10,736, down 107 points or 1%. Combined turnover for the Shanghai and Shenzhen markets total 1.6067 trillion yuan, down 77 billion yuan from the previous day. The midpoint rate of the renminbi against the US dollar was set at 7.1728, down 32 pips. On the Hong Kong stock market, coal stocks bucked the trend with gains. China Coal Energy rose 3.9%, while China Shenhua Energy and Yancoal each gained over 1%. According to the China Coal Market Network, recent coal supply has started to tighten, while demand has improved, easing bearish sentiment and supporting a price rebound. The price of 5,500 kcal thermal coal has climbed back to nearly 700 yuan per ton. Investment banks predict that prices could rise above 770 yuan per ton by June with the arrival of the peak summer season. Long term, however, major coal-producing countries like China, India, and Indonesia maintain robust output, with China's domestic overcapacity suppressing imported coal prices. On the demand side, global coal consumption is believed to have peaked in 2024, with a slight decline to 7.8 billion tons expected in 2025. Affected by slowing power demand growth and renewable energy substitution, China's coal demand may drop by about 1% this year. Our view on coal stocks is short-term bullish, long-term bearish. SY Pacific saw a sharp decline in performance and significantly reduced dividends, with SYA dropping 5.7%. For the year ending December 31st last year, revenue was 81.969 billion Hong Kong dollars, down 14% year on year. Profit fell to 4.321 billion Hong Kong dollars, or an 85% plunge, including a combined fair value loss of 5.974 billion Hong Kong dollars on investment properties. Excluding fair value changes in investment properties, major non-recurring items, recurring underlying profit was 9.284 billion Hong Kong dollars, down 11.15% year on year, while underlying profit dropped 71% to 10.471 billion Hong Kong dollars. Swire declared the second interim dividend, with SYA at 2.1 Hong Kong dollars per share and SYB at 0.42 Hong Kong dollars per share. For the full year, SYA's dividend was 3.35 Hong Kong dollars and SYB's was 0.67 Hong Kong dollars, both down 70%. Additionally, Swire Properties CEO Tim Blackburn noted that Hong Kong's office market remained under pressure over the past 12 months, with rental renewals still seeing negative adjustments last year due to oversupply and lack of new demand. The outlook remains weak, with no expectations of an office market recovery before 2026 or 2027. Wharf Holdings also released its full-year results for the year ending December 31st last year. Revenue was 12.115 billion Hong Kong dollars, down 36.1% year on year, while underlying net profit fell 21.5% to 2.798 billion Hong Kong dollars, primarily due to reduced recognized sales from mainland China development properties and an increase in impairment provisions to 2.018 billion Hong Kong dollars. Hit by a net revaluation loss on investment properties of 5.99 billion Hong Kong dollars, far exceeding the 1.617 billion Hong Kong dollars from the same period in 2023. The company swung to a loss of 3.224 billion Hong Kong dollars from a profit of 945 million Hong Kong dollars the previous year. With a per share loss of 1.05 Hong Kong dollars, the second interim dividend was maintained at 0.2 Hong Kong dollars per share, consistent with last year. The stock fell as much as 8.8% during the day, closing down 4.7% at 19.4 Hong Kong dollars. Earnings note AIA and Li Auto will announce their results today. The tariff war continues to escalate following the European Union's reinstatement of a 50% import tax on American whiskey. US President Donald Trump announced on Thursday plans to impose a 200% tariff on wines from France and other European countries, reaffirming his commitment to implementing a series of tariffs on April 2nd. Under the shadow of tariffs, US stocks saw significant declines. The Dow Jones Industrial Average dropped as much as 689 points during the session, closing down 537 points or 1.3% at 40,813. The S&P 500 fell 77 points or 1.39% to 5,521, marking a cumulative decline of over 10% from its all-time high on February 19, entering a technical correction zone. The Nasdaq slid 345 points or 1.96% to 17,303. The Nasdaq Golden Dragon Index, which tracks Chinese stocks, closed down 0.2%. Hang Seng Index night futures closed at 23,793, up 305 points, trading at a 330-point premium over the Hang Seng Index Thursday close. Tech stocks broadly declined, with Tesla, Apple, and Meta falling between 3% and nearly 5%, and Adobe plunging nearly 14%. Intel appointed industry veteran Tony Chan as its new CEO, boosting its stock by nearly 15%. US Treasury Secretary Bessent stated that he is not concerned about recent stock market volatility, emphasizing the government's focus on medium and long-term benefits for markets and Americans. He also suggested that the US economy will undergo a detox period, though this does not necessarily imply a recession. On the economic data front, the US Producer Price Index for February remained flat month over month, following a 0.6% increase in the prior period, falling short of the expected 0.3% and marking the lowest level in 7 months. Core PPI declined 0.1% month over month. Compared to the same period last year, the PPI rose 3.2%, below January's revised 3.7% and market expectations of 3.3%. Core PPI increased 3.4% year over year, also below forecast. Additionally, seasonally adjusted initial jobless claims for the first week of March dropped by 2,000 to 220,000, the lowest in 3 weeks and below the expected 225,000. Continuing claims for the last week of February fell by 27,000 to 1.87 million, under the anticipated threshold of 1.9 million, indicating that despite the prolonged tightening cycle, the US labor market remains relatively tight. With PPI coming in below expectations and tariff uncertainty rising, markets are betting on a more accommodative Federal Reserve monetary policy, pushing gold prices to challenge historic highs again during the US session, surpassing $2,960 per ounce. Our stock pick today is China Grand Pharmaceutical Group, stock code 512. China Grand Pharmaceutical Group is primarily engaged in the manufacturing and sales of pharmaceutical preparations, medical devices, biotechnology products, nutritional products, fine active pharmaceutical ingredients, and other products in China. Since 2018, it has accelerated its expansion into the radiopharmaceutical sector, taking a critical step toward globalizing its nuclear medicine layout through the acquisition of Certex. In 2020, it acquired Beijing Pu'er Weiye, securing radioactive drug production and operating licenses, and formed strategic partnerships with the Jiangsu Institute of Nuclear Medicine and the Nuclear and Radiation Safety Center of China's Ministry of Ecology and Environment, establishing a complete radiopharmaceutical industry chain from R&D to production and regulatory oversight. Subsequently, it collaborated with Telix Pharmaceutical Limited to introduce a range of radionuclide drug conjugates, targeting indications such as prostate cancer and brain cancer, forming an integrated diagnosis and treatment product portfolio. In 2022, it partnered with Shandong University to establish the China Grand Pharma Shandong University Radiopharmaceutical Research Institute, creating an early-stage R&D platform for nuclear medicine. After years of strategic planning, the group has successfully transformed into a leading innovator in nuclear medicine, becoming one of only 4 global pharmaceutical companies to achieve commercialized applications of innovative radiopharmaceuticals in oncology treatment. The group recently announced its financial results for the year ending December 31st, 2024, reporting revenue of 11.644 billion Hong Kong dollars, a 10.6% increase from 2023. Excluding the impact of renminbi Hong Kong dollar exchange rate fluctuations, the growth rate was 12.8%. Notably, the oncology radiopharmaceutical diagnosis and treatment segment recorded revenue of 589 million Hong Kong dollars, surging 176.6%, with its core product Egantai entering a rapid volume expansion phase. Profit attributable to shareholders was 2.468 billion Hong Kong dollars, up 31.3% year-on-year, or 34% when excluding exchange rate effects. In China, since the National Atomic Energy Agency, alongside 8 other departments, released the medium and long-term development plan for medical isotopes in 2021, the radiopharmaceutical industry has entered a new phase of development. According to the China Radiopharmaceutical Industry Status and Future Development Blue Book by Frost and Sullivan, The Chinese market size is projected to reach 9.3 billion yuan in 2025. Between 2025 and 2030, the market for diagnostic and therapeutic radiopharmaceuticals in China is expected to grow at a compound annual growth rate of 22.7%, reaching 26 billion yuan by 2030. Recommended buy price 5.9 Hong Kong dollars, target price $6.8, stop loss 5.5 Hong Kong dollars. I personally do not hold the aforementioned stock.